Greece could finally end up in default this week as talks on a key part of the bailout deal, getting the private bondholders to agree to huge losses, teeter on the verge of collapse. Athens is looking way short of the three-quarters majority it needs, and if Greece forces the deal on them, the rating agencies have ruled the country is in sovereign default. I'm joined now from London by Tim Price, investment manager at the PFP Group. Tim, welcome to the programme.
Hello.
Well, what do you reckon the chances are of the bondholders, the private bondholders, actually coming to heel? Are they waiting for a better deal?
It's difficult to say. I mean, I speak as a former bond salesman, and I can't really get my head around exactly what's going on in relation to Greek debt right now. ISDA announced last week that it wasn't a credit event. I fail to see how, if you're not going to pay bondholders back 100 cents on the dollar, and in fact, many of the private sector bondholders are going to have to take a haircut of something like 75%. I fail to see how that's anything other than a default. Greece is bankrupt. I think everybody knows it's bankrupt. The only issue for me as an investor is just how much worse it gets in a context of the wider Eurozone.
But technically, if we go for those three-quarters of private bondholders actually agreeing, if that doesn't happen, I understand Greek politicians have said they're prepared to use these controversial collective action clauses to impose the restructuring, and that's going to trigger the credit agency default anyway.
Yeah, I say my take is it's a very confused picture, but the bottom line is that Greece is not going to pay its bondholders back, certainly not 100 cents in the dollar. And you've already now had, with ECB action, you've effectively had two separate classes of bondholders. You've got effectively the sort of the institutional, the political movers, and they're going to be largely made whole, and that includes the ECB. And then you've got all those poor people in the private sector and investors and speculators and hedge funds and the like, and they're gonna have to incur a lot of pain.
We had the intervention again by the ECB last week. Do you think investors actually understand just how involved central banks and indeed the state is in the financial markets now?
I think that's an excellent question. I do question the extent to which particularly private investors are fully aware of the fact that these aren't free markets anymore. We're not operating in a free market structure. We're operating in an environment where central banks are printing money. That money is being given virtually free to commercial banks. Now, whether or not those commercial banks then decide to lend that on, and the chances are that in most cases they're not, they're choosing to hoard that capital. But either way, the state, for want of a better phrase, is hugely active in just about every asset now, and it's hugely distorting the prices of just about every asset right now. Trying to sort of see the wood for the trees is incredibly difficult.
Well, exactly, and I guess it raises the whole question of how safe an investor in a government bond now is.
Again, it's a very good question. We would draw a very clear distinction between lending money to objectively wealthy countries and to objectively poor countries. So there's
so what's an objectively poor country?
There's a metric that we invest with a specialist credit manager, and they have one metric that I think is tremendously important, and it's called net foreign assets as a percentage of GDP. In other words, net foreign assets is the totality of government-owned plus corporate sector plus household assets. And the reason why foreign is important is because central banks in their own currency can print money. They can always service their debts in local currency, but it's really important to have foreign currency as the totality of your sovereign wealth. And the bottom line is the world splits quite neatly into wealthy countries by that metric and poor countries. And the wealthy countries, by and large, are in Asia or in the Gulf, and the poor countries are, well, it's all of Western Europe, basically.
Tim Price, thank you very much for joining us. We'll probably come back to you in the next couple of weeks to see what's happened.